Good morning, everyone. This is Barry Knapp with Ironsides Macroeconomics. It's Monday morning, June 21st. We released our note this week early on Friday, the 18th, and it was titled Bullard Knows Something. The bottom line here is that this note was all about the Fed, and we have a major change in our tactical outlook from this point forward. And we are expecting a fairly significant equity market correction and policy normalization related uncertainty shock to begin. And we think it may very well have already begun, notwithstanding the pressure on the market Friday from index rebalances. We're going to have another index rebalance on Friday as well with the Russell indices. But setting that aside, there's a little bit of an interesting backstory here. Got up pretty early on Friday morning to be CNBC's first interview for the Squawk Box program, 6:10 Eastern time. It's a little bit earlier here in the mountains, and walked through our expectation of the dot plot having moved. We put out a note to our paid subscribers the Tuesday before the Fed meeting that the dot plot, as it had been constructed back in March, was nonsensical, that they were going to have to pull those rate hikes in and the forecasts were going to have to change. But still, we did not believe the Fed was ready to begin the normalization related process. We talked about that on Squawk Box and described how we weren't changing any of our allocation positions. Well, 2 hours later, St. Louis Fed President Bullard came on and rendered everything we said as incorrect in essence. Now, Bullard does have a tendency to be out in the tails of Fed views at times. He's overly hawkish or overly bearish, but we doubt very much that he misrepresented the comings and goings or perspective of the committee meeting on Wednesday. And it seems pretty clear that they are ready to start the normalization related process. Coincidentally, we had a note all ready to go describing how we thought that they were going to walk things back, and we still probably would have one more good leg to the reflation trade before they started normalizing that process. As we were doing that, a bear walked by our window. So a bit of an omen while my wife and dog were walking up the street. Anyway, little panic stations here in Colorado. But so just working through how these policy normalization related shocks occur and how they affect the markets. This has been our position all year long, that in order to have a 10% pullback in 2021, we needed significant policy tightening, either tax policy related tightening or more probably monetary policy related normalization. We believe that these corrections are inevitable. If you go back to pre-global financial crisis in 1983, Volcker didn't even tell anyone that he was raising the Fed funds rate by 125 basis points over the course of a couple of months to normalize policy, and there was an 8% equity market correction as a consequence. In 94, the Fed had a very aggressive rate hike cycle, raising the funds rate from 3 to 6. In a year, we had a 9% equity market correction. In 2004 to 06, there was Greenspan's measured removal of policy accommodation. Again, a very similar correction. Post the global financial crisis, those corrections started to get larger. In fact, the taper tantrum was probably the smallest equity market correction of the policy normalization related corrections. The end of QE1 was larger. QE2, the Fed and fiscal authorities were tightening policy. That one was very large, 19%. We obviously had the QT crash at the end of 2018 when the normalization cycle was coming to an end. So we actually had bigger corrections as a consequence of reducing asset purchases relative to rate hikes. And we would keep that in mind because we really didn't change the rate hike outlook all that much last week. Our policy proxy, where the Fed funds rate will be in 18 months, only moved up by 6 basis points or so. So we just pulled in lift off a little bit. This is really about reducing asset purchases and what that means for the markets. A key point of differentiation in our work relative to most people's work is that the most persistent effect of asset purchases when the Fed is buying mortgages in particular is to suppress interest rate volatility. The Fed is buying 100% of the net supply of mortgage-backed securities, and they do not hedge convexity risk or interest rate volatility risk. Pre-global financial crisis, Fannie and Freddie held $1 trillion each of agency mortgage-backed securities and hedged that risk religiously. The Fed doesn't hedge it. So releasing that supply of volatility back into the market is a vol positive event, and it will likely permeate across other asset classes, including equities. That's at the core of why we have these uncertainty shocks, and it is inevitable. There is no communication strategy, in my view, that the Fed can engage in that will mitigate or preclude having one of these uncertainty shocks. And so we think this is coming. Now, we think the Fed is acting, reasonably responsibly here. So it does take off, at least in the short term, some of the tail risk, most extreme scenarios that have really turbocharged Bitcoin, for example, this idea that the Fed is going to be behind the curve through the entire cycle. We don't really think that that risk has been completely mitigated. And once we get past the normalization process and out into 2022, we do think the Fed will again be behind the curve, in part because there's two factors that contributed to a low R star or natural rate of interest. That was slower productivity growth in the aftermath of the financial crisis and much lower inflation. That's what happens in the aftermath of financial crises. This wasn't a financial crisis. So we think the terminal funds rate, and this will probably be, again, a little bit of a differentiated view, is not going to be 2.5% where it stopped last go around. It's going to be much higher. The Fed is independent within the government, not of the government. They are going to be behind the curve, as we move out into 2022 and beyond. And personnel is policy. And it's very likely that Powell will not continue as the Fed chair when his term is up next year. Clarida could not be vice chair, and Quarles most certainly will not be the vice chair of supervision. So you will have personnel changes, and the Fed will likely become, on balance, more dovish, more Keynesian in its orientation, more focused on the labor market. But that's a story for another day. In the near term, we think that this policy normalization correction is imminent. We had a big sell-off on Friday because of, in part, the index rebalance, but also this shock realization that the Fed has had a hawkish pivot. We will have another index event on Friday. We think when you look at incoming data, good is going to become bad now. We had a little bit of a taste of that with the last round of labor market data. A strong ADP report caused downward pressure on the market, upward pressure on rates. A weaker payroll report, things move the other way. When we get to the next employment report a week from Friday, if it prints in line with expectations, 750,000 net jobs and a 0.4% increase in average hourly earnings, that's plenty to keep the Fed on path for reducing those asset purchases and getting the process going. Tactically, the only change we made this week was we took materials from a overweight to a market weight. That's an early cycle sector. We think it will probably be a sector we can go back to an overweight to at some point later in the cycle. We think that financials and energy will likely hold up reasonably well during this policy normalization related correction relative to other cyclical sectors. We think industrials could come under some degree of pressure, but we have lots of secular reasons to like the industrial sector, so we're disinclined to remove our overweight and think that you should be raising cash more broadly as opposed to trying to make some big sector rotation and get into defensive sectors for this risk-off event, which these tend to run for 4 to 6 weeks. They're fairly transitory and the market will reverse and rebound. So how you react to this depends a lot upon your time horizon and risk tolerance. If you can't take a 10% or 12% drawdown, cut risk. If you are fine with that and you already have some ammunition or money on the side, then just use this as a buying opportunity and sit and wait for the next month or so, because we do think these present very good buying opportunities from an intermediate perspective. they're never terminal to the business cycle or the associated bull market. But we do think a risk-off event is coming for sure. So one final note here, in our research this week, we did a bit of a project on house price correlation. Took the 20 cities in the old Case-Shiller, now called Dow Jones House Price Index, and created a correlation matrix to show periods when macro factors have been impacting housing prices. So this was a key in our call back in our Barclays equity strategy days, that the housing market and pressure on households was easing in 2011. Correlation fell. And in those days, we viewed it as excess inventories in Vegas were no longer impacting prices in Phoenix. That macro factor that pressured all prices downward was ebbing. Correlation was low or was dropping. In 2017 through 19, we had almost the ideal situation, the classic regional housing market. Correlation was very low and prices were increasing at a very manageable 5% rate. Well, right now, correlation is exceptionally high as it was at the peak of the housing bubble in 05 and 06, and prices are increasing at as high a rate as they were in 05, 06. So it's pretty clear that there's a macro factor. That factor is the Fed buying 100% of the net supply of mortgage-backed securities and early stage cycle forces. So the Fed is acting responsibly here and mitigating some longer term risks by moving sooner rather than later. So this is, in no way are we being critical of the Fed. We actually are pleased that they're doing this when they're doing it. This is the earliest they could have done it. The pandemic risks are receding. Nonetheless, this will cause an uncertainty shock, which is totally unavoidable. So you should position yourself accordingly. That's it for me this week. Happy trading, everyone. I'd use a little strength. We get it early this week, rebounding from that rebalance related pressures to reduce some risk. Barry Knapp, Ironsides Macro. Have a good week. More to follow on all this.